So you have $10,000 in credit card debt, $100,000 in student loans, and you owe another $20,000 on your car note. But do lenders really care what the balances on your debts are when qualifying you for a mortgage? I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and I'm here to help you. So what do lenders really look at when they're calculating your debt to income ratio, meaning the amount of money you make monthly versus your monthly expenses? Do we really care what the balances on your debt are when doing that calculation? Well, I'm going to show you exactly what we look at when we're calculating your debt to income ratio so you have a better understanding of what you're getting into once you apply for a mortgage. So what we're going to be talking about is your DTI. You may have heard that. It stands for debt to income, and it's your debt to income ratio, right? Income versus your monthly expenses. Now, as I mentioned, it's oftentimes that I speak with someone looking to get qualified for a mortgage, and I ask, hey, what do you have on your credit report that you pay on a monthly basis? And they start to rattle off what their balances are on these debts. Well, believe it or not, lenders are less concerned with the balances on those debts than they are with the minimum monthly payments for those debts. Because your debt to income ratio is based on those minimum monthly payments compared to your monthly gross income. So let me give you some examples. So let's just say, as I mentioned in the beginning of the video, you have we'll call this credit cards. You have $10,000 in credit card balances, but your minimum monthly payment for the $10,000 in credit cards is $225. This $225 a month is what we're using in your debt to income ratio. We're not looking at the $10,000. There are some debts where we would actually look at the balance, but that's normally if a payment's not reporting. For example, let's just say you have a credit card with a balance of $1,000 on it. And on your credit report, it has a zero payment, right? That happens sometimes. It's a revolving credit card. There's not a payment reporting for that credit card. Well, in that case, we would use 5% of the balance to calculate your monthly payment. So we would use 5% of $1,000, which would be $50, right? So we use $50 on a debt where there's no payment reporting if it's a revolving debt, right? Easy enough. What if you have a student loan and your student loan reports a payment, right? So we have a student loan, say SL, your student loan is $50,000. Maybe it's broken up over multiple student loans, could be. So you have $50,000 in student loan debt and it's reporting a payment of zero. Okay, well, we're gonna look at that credit report deeper and we're gonna say, okay, is this zero because the loan is in forbearance or deferment, or is it actually a zero payment? So let's just say in this case, it's a true zero payment because you're on an income-driven repayment plan with the creditor, right? Depending on what student loan provider it was. If it's a zero payment and we're doing a conventional mortgage backed by Fannie Mae, we can actually use zero, which is pretty incredible. Now, let's just say it's in deferment or it's in forbearance, right? Well, your payment wouldn't actually be zero, although that's reporting to credit. We need to figure out what your payment would be. So let's just stick with doing Fannie Mae's calculation, right? So, and you should watch my video on how student loan debts are calculated. Make sure to check that out because I break it down based on the type of loan you're getting because it varies from loan to loan. However, let's just say it's Fannie Mae like we just mentioned. So this is for deferment or forbearance, but you actually need to make a payment, right? So as a lender, we're gonna go ahead and we're gonna use a calculation for this. So we said it's a Fannie Mae loan. So it's Fannie Mae, we're gonna take this and we're gonna multiply it by 1%. 1% of 50,000. So your monthly payment that we would use toward qualifying is $500, right? We're not hitting you with the full balance, we're hitting you with 1% of the balance, which gives you a $500 per month payment. Like I said, check out that other video because that payment could be less depending on other calculations that are available based on the type of loan we're doing. So that's student loans. Now, let's move on. We're still doing a conventional loan here. Let's just say that you have a car loan, right? Not a lease, it's a car loan. So we'll say your car has a balance on the loan of $12,000 and your monthly payment for this car that's reporting to credit is, make this simple, let's say it's $1,000 a month, right? Probably not that high, but let's just say it were that high. There's a couple ways we can look at this. For one, we can use the $1,000 in your debt to income ratio, right? That's the normal calculation, right? The minimum payment that's reporting to credit. But there's a better option if you have a tight DTI, like a high debt to income ratio and we're trying to get it down. If we're doing a conventional loan, and I already said this is a loan, not a lease, right? 1,000 into 12,000 is 12, right? 1,000 into 12,000 is 12, right? That means there's roughly 12 payments. Of course, there's interest and so forth, but let's just keep it simple the way we do in the eyes of a lender, and there's 12 payments. Well, on an installment debt, if you're getting a conventional mortgage, not FHA right now, I'm talking strictly about conventional. If you're getting a conventional mortgage and we can get this down to 10 payments or less, we don't have to count this in your debt ratio. So what I would normally do in a situation like that is I would have you as my client make 2 payments, right? 2 payments of $1,000, right? So we'd say 1,000 times 2 equals 2,000, right? Have you make those 2 payments in advance. 2,000 off of 12,000 leaves 10,000. 1,000 divided into 10,000 equals 10. This number allows me to not count this debt, or any lender to count this debt in your debt to income ratio if you're getting a conventional mortgage, because the guideline states that any installment debt, and that's why I said it's a loan, not a lease, any installment debt with 10 or less payments remaining can be omitted from the debt to income ratio. So by paying this down by a couple of grand, right, in this example, allows me to omit that debt from your obligations, making it easier to qualify for a mortgage. Now, the reason I said that was conventional is because it's a little bit different for an FHA mortgage, for example. FHA, you can do the same thing as long as this monthly payment is not greater than 5% of your gross monthly income. So it's a little bit more difficult to make that work. However, it is possible if you have high enough income compared to your whatever your monthly debt is for that particular loan. If this was an auto lease, right? So we have a car lease. The balance is irrelevant. Let's just say the payment was $1,000 a month for the auto lease. Even if you only had 1 payment left on that lease, we still need to count that in your debt ratio unless you have another vehicle that can replace that one. Because we know that a lease, once it ends, that car needs to be replaced. It's not like a loan where once you pay the loan off, you own the car outright. With a lease, it just means you're done paying on the portion or the amount of time that you're going to own that car. You still need another car, right? And like I said, unless you have another car and we can prove that by showing title or some other method, then it's not going to be an option to omit the car lease, even if there's less than 10 payments. Like I said, even if there's only 1 payment left on that car lease. Now, this is how we look at your debts. Now, what about your income, right? The other half of debt to income, right? This is debt, how we look at that. But how do we look at your income? Well, it's rather simple. If you're not self-employed, let's just say you're a wage earner, right? W-2, which is what I mean by wage earner. It's really simple. I'm going to use a little bit higher numbers to make the math easy. Let's just say that you have a salary of $120,000 a year. We would take this number, we divide it by 12, and that gives us $10,000 a month of income, right? Very, very simple. We're not taking out taxes or anything. We're using your gross monthly income, right? Easy math. Let's just say you're retired. And let's just say you have Social Security and you have pension, for example. Let's say your Social Security is $2,000 a month. Let's say your pension is $1,000 a month. We add those two together and we have $3,000 a month of income. Now, here's something that most lenders are not going to tell you about. Let's say you are on a fixed income, right? You're retired and Social Security and pension, for example, and that income is not taxable, right? As determined by your filed tax return. Maybe all of it just falls under the non-taxable bracket, so you have no income tax. We can actually take this and multiply it by 1.25%. So essentially grossing your income up by 25%. And that's going to give you an additional $750 in this example of qualifying income, right? Because it was grossed up. So if you are on a fixed income, you're talking to your lender and they're telling you, oh, you don't qualify, but you know you don't pay any taxes on that income, make sure to bring up to them that, hey, I don't pay taxes, can you gross my income up for me, right? That's important because some lenders don't know that guideline and it can help you qualify for more than you would if they didn't gross your income up naturally, right? More income is going to make it easier to qualify for a higher purchase price. Now let's say you're self-employed, right? So that's the other alternative. So in all these situations, we're talking about gross income. So when I talk to someone who's self-employed, and check out my video on the best loan options for self-employed borrowers, but let's just say you're self-employed and I say, hey, how much do you make each year? Naturally, most self-employed individuals are going to tell me what their business made, right? I talk to someone and they tell me that, oh yeah, I made $500,000. Like, that's fantastic. You made $500,000. So that's what you actually paid yourself and paid taxes on. And then the conversation turns and they say, no, that's what my business made. When it comes to being self-employed, we don't look at what your business made. We look at what you made, because we're not lending to the business. We're lending to you as an individual. So sure, business might have brought in $500,000 in revenue, right? Gross receipts, but it might have cost $400,000 to bring in $500,000, right? So subtract the $400,000 in expenses, and what we're actually going to look at is what's left over, right? So in this case, $100,000. So maybe that's not enough to qualify for what you want if you're self-employed, right? Of course. And if you've been in business less than 5 years, we're having to do a 2-year average, or if you're getting an FHA loan, we have to do a 2-year average no matter what. So make sure to check out that video I mentioned on self-employed loan types and how we qualify you and so forth. But just keep in mind, if you're self-employed, we don't use the amount of money your business brought in to qualify for a conventional loan or an FHA loan or a VA loan. We use the amount of money you as an individual made, because we're lending to you as an individual. So when we're calculating your debt to income ratio, real simple. Whatever your income was, right, we're going to go ahead and we're going to take that number on a monthly basis. So let's just say it's this $10,000, just to keep it easy. So you make $10,000 per month, right? That's your monthly income. So I'm going to say I for income. And then let's just say that your monthly debt is existing debt. Let's just say you have $1,000 in existing debt. But what you also have to factor in, and a lot of people forget this, is whatever your payment's going to be for the house you're buying. That gets factored into your debt to income ratio as well. So let's just say that your monthly payment is going to be $3,600, right? So principal, interest, tax, and insurance. So what we do is we're going to divide this $4,600 into this $10,000. So $4,600 into $10,000 would equal 46%, right? $4,600 is 46% of the $10,000. 46% represents your debt to income ratio. The amount of money you make monthly, gross, so pre-tax, compared to your monthly expenses that are on your credit report, along with what your payment will be on the property you're buying. And that's what lenders are going to look at when calculating your debt to income ratio. So it could vary a little bit from loan type to loan type. So make sure you speak directly with your lender and go over your own scenario. I don't want this to deter you from applying for a mortgage, but at least you have some knowledge going into the pre-approval process of exactly what lenders are looking at. I don't want you to stop yourself from applying just because maybe you thought they're going to look at your full balances on debt when qualifying, right? This might make you feel a lot more comfortable with actually speaking to a lender, which I highly recommend, going through your own scenario and finding out what's going to work best for you. So if you want to see more videos like this one and continue educating yourself on mortgages and real estate, make sure to subscribe to this channel. And if you have questions about your own scenario, leave a comment below. I do reply to 100% of the comments left on my videos.